Well, the hot topic is international oil supply, the Iranian war, and all the components about what's going on in terms of transportation, logistics, supply and demand across the globe. But what I haven't talked about is how that's working here in the United States for the U.S. oil and gas companies, U.S. oil and gas producers, and exploration companies. So, what is the reality today? The reality today for U.S. producers is the following. Over the last 8 years, the U.S. oil and gas industry had every single executive order, plan, policy, regulation, everything was anti fossil fuel. Yeah, I'm talking about the Democratic president, I'm talking about the current president. Everybody used the oil and gas industry in the United States to cut off our capital, to make banks make it very difficult to lend us money. It made it difficult for shareholders to buy stock. It made it difficult for private equity and hedge funds to jump in and participate in oil and gas with capital. And the oil and gas companies were essentially told, go on a diet. Go on a diet and learn how to be self-sufficient and self-contained. Only spend money that comes out of the revenue from your wells. Only grow according to the current size of the economy, the current level of consumption. Don't overspend. Don't reach. In fact, contract. Get tight. Get efficient. Drill better wells for less money. Drill fewer wells, but better wells. Stay in areas. Don't build pipelines. Don't build infrastructure. Don't reach beyond your free cash flow. Don't look at expanding across the globe. Instead, buy each other out. Consolidate. Cut overhead. Let go employees. Recreate the hierarchy of best in class versus somebody else's best in class. When you combine the two, now you have one best in class and you create a longer runway of wells to drill. The U.S. oil and gas industry has taken a beating since about 2018, and it's been brutal. And really, it probably was a beating that started back even during, let's say, 2008, after oil prices dropped from a record of $145 a barrel, went as low as $32 a barrel. Then it climbed out and went to $100+ a barrel, and then by 2016, it was back down to in the 30s again. And it climbed out again, and then President Trump got elected and says, I love $50 oil. There was no economics applied to that comment. It was just he wanted cheap energy. So his policies, his direction, his push forced oil down arbitrarily down to middle 50s, $50 a barrel for 2 or 3 years of his administration. Cheap energy makes great economy. Cheap energy means no reinvestment. Cheap energy means delayed investment. Cheap energy means you're risking the country's energy future because we have declining oil wells. The oil wells producing today have less oil and gas in them tomorrow. And if you don't go like a farmer, if you don't harvest your crop until the crop to plant next year's seeds, you don't have a crop next year. Oil and gas is the same thing. If you don't give us a financial runway, we simply take the profit off our wells today, whatever you pay us for oil, whatever you pay us for natural gas, we balance our budget and say, based on the price we got paid, we can replace a third of our reserves with new wells. We can't replace 100%. So we're in a negative free fall for lower production. You guys are making a ton of money. You guys are fantastic. You, the oil companies, you screw the American consumer because you charge us higher prices. Like right now during this Iranian war, you're sticking it to the consumer by charging $100 a barrel. I'm going to let you in on a little secret. Ready? Here's go. If the U.S. oil and gas companies controlled the market, do you think oil would ever go to $40 a barrel? Do you think forever in 2020 that oil would sink to negative $37 a barrel? Do you think we'd ever produce oil or sell oil or drill wells below our break-even price? If we controlled the price to the upside, we'd also control it to the downside. See, we don't control the price. We're like cotton farmers. Cotton farmers have an estimate of what the market of supply and demand for cotton is before they ever plant the seed. Then they plant the seed with expectations of supply and demand, knowing there's a lot of risk. Storms, weather, drought, hail. They then calculate the cost of fertilizer and growing that cotton field. And they calculate what it's going to look like to harvest that cotton at the time that it's ready to go and be taken out of the field. And then sure enough, here comes the market. And the market says, you know what? We made a mistake. We don't have as many cotton buyers as we thought. So the price is not 80 cents a pound, it's 42 cents a pound. Barely enough to pay off the bank and break even. Or maybe it's only 32 cents a pound. You now don't even have the money to pay for the fuel to harvest and take that cotton out of the field. Oil and gas companies the same way. Farmers don't set the price. The traders in the market set the price. And that changes 24 hours a day, 7 days a week. So today, the American oil and gas industry is looking at its own reality. And the reality is, we've been on our own for about a decade. And in a decade, we've had to make very critical decisions. What are those decisions? We can't go out and borrow money because the minute we stub our toe, they call the covenants in our loans and they make us pay back loans at the worst possible time. Don't borrow money. Shareholders, they're uncertain. It's 120 a barrel, it's $35 a barrel. So only certain long-term investors buy Exxon stock or Diamondback stock or Chevron stock. They're looking at a 10, 20-year investment, not a 24-month, 12-month, or 6-month investment. You don't trade Exxon daily. If that's true, then what we have is we have an industry that says we're capital constrained. Don't take any free cash flow and do anything crazy with it. Maybe what you do is you perfect your drilling. You drill better wells at the same price or cheaper, that we have higher production, and you can actually make more revenue by selling more oil. What does that mean? We're depleting our tier 1 assets. We're drilling our very best producing wells on the very best acreage with the greatest, latest technology of drilling and fracking. In other words, we're taking the very best we have in terms of all aspects of production and exploration in the United States, and we're putting it forward today. We're taking that revenue from that effort and we're using it to drill other best-in-class assets. But what we're doing is we're selling off and draining our best reserves today. What's the backside of that going to be? When we run out of tier 1 and best-in-class, when we squeeze the efficiencies out of every operation, every dollar we spend, and how we drill the wells at the best price for the best result, when we squeeze it to the point there's just not any more accretive effort that can be applied, now we truly are in a declining measure of output. Now we're truly in a decline in terms of efficiency. The only way to overcome that is to drill more wells. If you drill more wells, we need more capital. We can't get more capital because we're only getting the revenue from our wells, which means what? The price of oil is going to have to go substantially higher to create more free cash flow to let oil companies just maintain the current output. No one wants to tell you that as a consumer. No one wants to tell you that as an investor. But I can tell you, as somebody who's been in oil and gas since 1985, I can tell you as an operator, an exploration owner, managing a lot of money on my own company's behalf and those of my partners. What I can tell you is we don't hear the mantra, drill, baby, drill. We hear the mantra, which is stay calm, stay in the pocket, don't overextend, don't retreat, just keep the path, and the market is going to have to pay us what the market determines crude oil, natural gas liquids are worth. And that change is not up to us. The change is up to the traders and the anticipation of supply that exists that can be obtained and what the demand is for that supply. And the arbitrage is the differential between that supply and demand, and that changes every 24 hours a day. So for us as an industry, just letting everyone watching this video know, we've been deprived of any excess capital for going on a decade. 10 years of not plowing that field, 10 years of not sowing that seed, 10 years of not putting fertilizer, and 10 years of ignoring capital costs and improvements to the tune of about probably $1.5 to $2 trillion means that somewhere in the not too far future is going to be this point of no return where the wells can't be drilled any better. You can't drill them with any better output. You're running out of tier 1 assets, best in class, and all that's left is we will drill the next layer down from best in class, which becomes best in class because you don't have best in class anymore, but it's going to take $20, $30, $40 a barrel more for us to do that. When is that going to take place? Well, that's the crystal ball. That's the $1 million question. I don't know if it's in 3 years or 5 years. My best guess is we will reach a point of diminishing tier 1 assets in the next 5 to 10 years. At the pace we're going, I don't think it's going to be quicker, but it's more likely to be closer to 5 years than 10 years. And that is a simple reality. And that reality means much, much higher energy costs for oil and gas in the next decade. Like it or not, that's the reality of what political policies do when you cut off the incentive for capital to assist in growing back declining reserves. Thanks for listening.